Good afternoon once more. Thanks for this warm reception, and thanks for the introduction and the invitation. Very happy to be here, and I think it's a really good thing of you that you started this presentation right now, where gold isn't actually being discussed a lot, which I think is unusual, and it's great that you guys are interested in gold right now, not when everybody else is interested in gold. So I think we had a lot of good content, and I would like to add to that, and I hope I can provide you with a few thoughts. So I don't have that much time, so I'm really gonna speed up, and I want to really only bring 2 or 3 points to you, and I hope you will take away something from that. So just a few words on myself. Mark Valek, my name. I'm from Austria. I really like the Austrian School of Economics. I didn't discover that in our great university system, unfortunately. I had to study this by myself, and really a fan of Hayek, Mises, and so on. I think everybody should have a look in these kind of books if one is interested in economics. Probably most of you know of them anyway. I always have to say that by now because it became some kind of a routine because of my Austrian accent. They called somebody on YouTube started calling me the Arnold Schwarzenegger of economics. So I rather embrace it instead of hating it. So okay, I go with that. Perhaps even better, Arnold Schwarzenegger of Austrian economics. That would be my perfect match. What we are looking at is gold and crypto. In Incrementum, I started writing about gold 2013 together with my dear partner Ronnie Stöfferli, who's been doing that even longer, since 2006. And we publish an annual report, which is quite a brick by now. And it's available on ingoldwetrust.report. It's coming out 27th of May, next one. I think there will be a lot of interesting stuff in there. By now it's quite a big team. It's 15 people working on that, project based, so some of them fixed, some of them especially only for this project, and it has a huge following, and we're quite proud of what it actually has become. So we're really motivated to bring out an even better report every year. Also, since 1.5 years we are writing about the crypto space. I got interested via my interest for gold, first of all in Bitcoin, but I mean crypto is fascinating. It's a broad space. There's so many facets. We could talk for hours and hours, but just to let you know, also a quarterly publication is available on Crypto Research Report. It's like the small sister report of the Gold Report, and it's mainly edited by Demelza Hayes, which is employed by us, and she's an American, very smart girl from the US, and she's doing her PhD on crypto in Liechtenstein, so a lot of things going on. We want to just give a very short shout out to our partners, because without these partners we wouldn't be able to make the report, and we wouldn't be able to provide it for free. So a special thanks to them. We'd like to thank them on conferences like these. And yeah, so let's dig into the content. So has anybody got an idea who may have said this quote? Gentlemen, in applied mathematics, you must describe your unit.
Einstein.
Einstein? Not even that bad, but not quite earlier than Einstein.
Heisenberg.
Heisenberg, even earlier, I think. Other physics fans here in the room? Newton, I heard it over here, yeah. It was Isaac Newton. Isaac Newton was a mathematician, but he also was, not that many people know, he was the master of the Royal Mint and basically the godfather of the gold standard. And I find this quite interesting because he actually approached the topic from a more mathematical or physical standpoint, meaning you need to define your unit if you measure something. You need to define a meter, has to be a meter, and whatever you want to measure needs to have a fixed unit. And basically this sums it already up for what the case for gold. gold is a fixed unit. Why do I say that? So I just want to really go over this briefly. Dimi mentioned it among other things. He had a whole lot of very good points, I think.
One thing, could you stay in the middle?
I'm sorry, nobody.
I'm losing you.
Okay.
Or a bit that side.
Yes, sir. Okay. Try to stay here. So the concept is, what does it mean? Why is gold a good unit? So what we are looking at here is the annual growth of gold during roughly the last 100 years. And the annual growth of gold is very constant. So it's pretty much 1.5%. It varies from time to time. It's a little bit lower than that, a little bit higher than that, but very low variance in this number. So that means gold isn't actually that valuable because it's so scarce. Yes, of course it is scarce, you can't print it and so on, but gold has been mined for thousands of years and it's hoarded. So every year the same amount, more or less, comes to this amount, and you as a gold holder can be very sure that you won't be diluted by a lot of new gold supply which is coming to the market. So the very interesting property and the most interesting property of gold is its constance, its constant quantity. So the 180,000 tons Dimi mentioned, which is the estimation of the global above Earth gold supply. This is only growing very slowly by 2,000–3,000 tons a year, which is 1.5%. So it makes a very good unit to describe, to define your measurements, to measure things in it, because it's not completely constant, but it's the most constant physically thing above ground. I mean, there are a lot of other arguments for gold as well, but I think this one is often overlooked, and that's why I wanted to take the time to point that one out. So this is also actually called, this concept, stock to flow. How many people of you know stock to flow ratios? Okay, so that's really easy. It's just basically the inverse of the inflation rate of gold or any commodity. So gold has approximately 70. So that's like 1 divided through 70 is 1.5%. So it grows with 1.5% each year. Silver is much lower, was higher initially, but it became lower. It still has therefore some monetary properties, but not as good as gold, because as you know, silver is also used for industrial measures. And all the other basically commodities have a very, very low stock to flow ratio. They are consumed. So basically everything which is produced is kind of burnt or digested if it comes to wheat or to agricultural stuff. So you only produce commodities to consume it, except for gold and silver. These are used to hoard it. It's a strange concept, but I think it's a fundamental concept to which one has to understand to really fully comprehend precious metals. So where am I going with this? There's another thing coming up here, and it's Bitcoin. And Bitcoin's stock to flow ratio, or Bitcoin's inflation rate, is not quite constant, but it's becoming more and more constant. It started out pretty low stock to flow ratio, so high inflation rate. So these are the numbers between 2012, 2016. This is where we are right now, almost. In 2020, because of the algorithm how Bitcoin was set up, the inflation rate goes down every 4 years. It's called halving. So the units which are produced go down every 4 years. So that's why over time the stock to flow ratio gets higher and higher, until Bitcoin one day will reach 21 million units. No more inflation. The stock to flow ratio will be infinite. actually, so there's zero inflation on Bitcoin. Does it mean it's better than gold? I wouldn't say that, but it's just conceptually even harder than gold. That's the idea behind Bitcoin, to have a zero inflationary monetary unit, which should be a quite good store of value, similarly like gold. In this respect, yes, one could argue it's actually better, but it has other properties where it's just different. So I really don't like this comparison so much, which one is better. Both have advantages, both have disadvantages, but just conceptually, this is important to get. This is basically the same, just in a different graphic. So we are almost breaking through the stock-to-flow ratio from gold now. Okay, so when it comes to investment, like I'm fund manager, I look at correlations, I look at distributions, and I look at this kind of stuff, and how to combine different asset classes. That's I think an interesting thing to think about. And we have put on here the distribution of gold, the returns of gold, and also of Bitcoin. And most of the financial assets have some kind of symmetrical distribution. So like stocks, so I'm sure most of you know the normal distribution. This is too easy. This is probably not the right way to describe reality, but at least the distributions are more or less symmetrically. At least with stocks they are. With bonds, most of the time they are, if you don't have a default. So if you have a default, it's suddenly your return distribution gets skewed to the left very abruptly, because and one day if they default, suddenly you don't get the interest. So it's a huge tail which one has on the return distribution. And Bitcoin is skewed to the right. So there's an asset which has a high optionality. It has the potential to double, to triple. It showed that it has this potential. And in my view, and when I discovered Bitcoin relatively early, I figured this out for me too, that it would have to be like that. Because I thought there are a lot of risks why Bitcoin should perhaps not be able to deliver the promise to be a good store of value, because the technology could advance, for instance, or there could become something, they could hack it, they could attack it, and so on and so forth. I still think that these risks are here, but nevertheless, if it really comes up with this promise and is useful as a store of value, then the valuation is so low that it has to be skewed to the right, the returns, because then it has to rise within the multiple. So taking this kind of worldview and trying to put it into some kind of a portfolio concept, that was basically my personal challenge. And when I started also investing into Bitcoin, it was for me relatively easy, because I thought, okay, the good thing is I don't have to bet a huge amount on this stuff, because as the return potential is so high, I just need a small position of my portfolio, and I have to be willing and able to lose all of it, because it's super risky. But if it goes up, the small position will have a nice impact, and that's good for me. Stupid fool, because hadn't I thought like that, I would have put a big position in there, and that would have been better from an absolute point of view. But looking back from portfolio management point of view, I did everything correctly. But so I was able to invest a little bit earlier, which was good. But sooner or later, the question appeared: when to sell? How do you manage this whole exposure? I'm going to come to that point in 1 second. So I just want to point out a few other differences, so that the return distribution is different. The volatility is extremely different, obviously. So Bitcoin is factor X volatile, 10x more volatile roughly than gold. And this is the interesting point. The correlation is very low. So even though the concept of Bitcoin is similar to gold, the founders of Bitcoin clearly knew Austrian economics, clearly knew monetary history, and made the algorithm in a kind of way which should help to compete with gold. But nevertheless, for now, for the time being, the prices don't correlate at all. Bitcoin rises, gold falls, vice versa, or is no correlation. And this is a rolling correlation, has been pretty stable. And that, from a portfolio manager's angle, is a very interesting property, because if you have zero correlation, you can reduce your overall risk if you combine these two things. So that's good to know. So what do we do with this information? We also looked at the drawdowns of Bitcoin. So going back to the volatility is often used as a risk measure, as the risk measure. I think it's probably not the ultimate risk measure. A more interesting risk measure is the maximum drawdown. What does it mean? That means how much would you have lost if you would have invested at the worst possible time, like in the bull market, where you think, oh great, I'm going to invest, December 2007, and here we are, March 2019, gonna log into my account. What's the value left? Minus 80%, minus 90%. So this happened recently. We are, I think, more than minus 80% now, roughly, from the top, and it happened 3 times before that as well. So you can, Bitcoin and all the other cryptos, clearly high risk asset. So that's also to obviously to take into account too. But on the other hand, we have gold. Gold, which has a much lower volatility in terms of daily movements and so on, can also have quite a significant drawdown. So that's almost 50% since the peak in gold. Which, if you would have invested, when did you invest, Brecht?
May of 2011.
If you have invested in May of 2011, sorry. But credit to you, I really find it good that you're so open with that, because every investor has highlights and lowlights, and you did a good job with the other things which you showed us. But gold can fall, we know that, right, for now. So, but nevertheless, that's 50%, not even 50% versus 80%. So it's a difference. It's quite a big difference. So how can we basically sum this knowledge up to some applicable strategy? We have this Bitcoin performance now, and the question is, when should we sell? When should we sell? It's not that easy. You know? Even if you were invested in a very good time, if you invested some time down there, what to do and how should I ever sell again? I don't know. So okay, I skipped the page, but it doesn't matter actually. So this is what we would propose, and this is actually what I ended up doing unintentionally initially, and now I'm doing this much more consciously. So I'm a big investor in gold and precious metals. I completely buy into the story. You don't have to convince me. So I'm on board there. So this is actually one of my main positions. But I also had the satellite position of Bitcoin. It grew. So what I did, I just took profits and put it into gold and silver, but not all at once. Always at specified dates, right? So not dates, excuse me. Specified portfolio allocations. So what we are looking into now, and we looked in all kind of combinations, but we find it's quite an interesting combination, would be like 70% gold and 30% Bitcoin as a starting point, and then let these allocations fluctuate quite a bit. So for very easy implementation, you can do every time Bitcoin doubles, or your Bitcoin allocation doubles, it goes from 30 to 60, you sell half of it. You just cut your allocation and you buy gold. You buy gold with the profits. If Bitcoin falls in half, like from 30 to 15, you double up again. You take some of the gold and double up. And this is called rebalancing. Rebalancing your portfolio. It's something very simple. It's nothing new. And people and fund managers do that all the time between stocks and so on. But in reality, between stocks or between assets which correlate, the effect isn't huge, because it's really only taking off a few percentage points here and there. But as these two assets are not correlated, have a hugely different volatility, this works very, very well and helps you to just identify times where actually, most of the time, Bitcoin, obviously, because it's the more volatile asset, Bitcoin is doing really well. And the difficult thing is one has to do it then. You know, that it's really, one has to stick to a rule-based approach. So what we tested now to have this in a more like structured way, what would have happened if we did this with 30%, 60%, sell every time it hit 60% and vice versa. And okay, so what happened, this is only the last 3 years. We did it for the whole entire time until we have data, but you don't see it that well, so I only put up here the last 3 years. You already would have sold beginning 2016. So, well, that wasn't the best sell, probably. But then came 2017, huge bull market. You would have sold in autumn 17, doubled down again, took profits, bought gold within. They would have sold in pretty good, I think, in November 2017, super into strengths. You would be completely counter-cyclical with the strategy. Took the profits, bought gold again. And what happened then? Well, price broke down. Price broke down, and actually it would have triggered a buy signal a little bit early, but at a pretty nice point in time. You would have doubled up. Since then, you wouldn't have done a lot, and now we're basically almost back to a buy signal. Almost, not yet. So this model will then just double up again, which I think personally is again quite nice, quite counter-cyclical. Actually, that's what you want to do as an investor. So this is, in a nutshell, basically the strategy. What everybody can do it by himself, but we are also planning this as a fund. So nobody has to do it, and nobody has to go to the trouble with like looking at when has my portfolio doubled and so on. So this is all outsourced. And it is also, I think, the probability that one really does it by oneself is a little bit lower probably, because once you are in a bull market, you really have a difficult time selling because it's so much fun and it's doubling like every 2 months or 3 months. You just don't want to sell right now, right? So it's easier said than done. So that's why these rule-based strategies, in my view, are really important to make some kind of profits out of this high volatility. Yeah, so, and the interesting thing, and that's now really interesting to me, is if you go with these numbers which I just proposed, so Bitcoin 30%, gold 70%, and let this breed between 15 and 60%, the Bitcoin position. Even though you have from time to time a lot of Bitcoin, the drawdown, it was higher than gold slightly, but not that much, so similar to gold. Much lower, obviously, than the pure Bitcoin investment, and yeah, so that's a huge finding for me, that you can really run such kind of a strategy with similar risk profile. Obviously, the returns, I won't even say what it returned, because it's just, I mean, this bull market is, the first part of this bull market is difficult to be repeated, but I still think there's a huge upside, especially now again, since we've fallen down. So the profit would have been much, much, much higher than gold, which basically did nothing during the 8 years. And personally, it bailed my private portfolio also out. Otherwise, I would have treaded water the last year. So yeah, I think this is really something which one should consider. And here are still a few numbers. We played around with the different allocations. So I mentioned this strategy with 30% and 70%. One can go lower, one can go higher. But what this chart shows basically is that these Sharpe ratios, so that's a number for risk-adjusted returns, basically always are higher if you do rebalancing, and if you do rebalancing with a higher band, then these Sharpe ratios generally improve even better. It just proves that rebalancing works with the strategy. A few other points, numbers. So again, the max drawdown versus return. I didn't mention the return, but here you could see it. It was like 60-something% per annum for the last 8 years since we calculated this. You really have this diversification effect kicking in once you put in gold with Bitcoin together. Whoops. So yeah, that would have been the chart. Just to note, this is the gold chart doing not much down there, and this is US equities, which haven't been that bad since 2010, by the way. So you would have outperformed US equities by amazing gap. Not as good, obviously, as the pure Bitcoin investment. That just cannot be. But much fewer drawdowns during these ways. This is a log scale, note that. So this is 90% drawdown, this is 90% drawdown, this is 90% drawdown. Whereas this is only like 30 or 40% drawdown, not quite sure. But you get the message. So interesting strategy. You can do it yourself, or if this is interesting, you can contact us. I put up a URL at the end. Conclusion. This is, I would call it actually a conservative strategy, combining gold and Bitcoin. Why conservative? Well, crypto and conservative may be a strong word, but it's definitely the most conservative cryptocurrencies out there because it's the best tested and the most robust at this time. Low correlation and low volatility increases the diversification effect. So that's also a very good point why this actually works so well. And disciplined rebalancing can increase the risk-return attributes significantly. And this simple rebalancing strategy is actually something that can help you to buy low and sell high. As easy as this always sounds, it's really extremely difficult in practice. And yeah, this is the URL. More infos. If you want more infos due to regulatory reasons, I can't go into depth in here. But we are. If you want to contact us in here, we can send you stuff. Yeah, I think I'm through. I hope I did good with the time.
Yes,
I tried my best, and open for question. Thanks.
Any questions? So Mark, to be clear, the idea is that you will put up a fund doing this.
Exactly.
And then people can buy, what, a share of that fund, or how does it work?
Yeah, so we're Liechtenstein-based asset management company. So we said we have 5 funds running for 6 to 9 years or something like that. And we set up funds which are also based in Liechtenstein. And what we are looking at is having also a physical solution where we have physical gold in Liechtenstein, as this strategy is not very trading intensive. One can do it also with physical gold in a sensible manner, and that's where we want to go with this.
And
yes.
this will not be a publicly traded fund. It will be like private equity, let's say.
Well, it's a regulated fund, but it's not listed on any exchange. But one will be able to buy it on a weekly basis.
Okay. Next edition of Macro Trends, I will have an article about your fund.
Cool. Thank you.
Good. The floor is open for questions.
Sorry, do I get you right? A simple mind like me, I understand gold and silver, but I don't understand crypto, so I'm not into it because it scares the hell out of me. Do I come to a guy like you to take care of that? If I want to get into it?
Yeah, I'm happy to talk about it anytime. So it's my.
Does your fund or whatever you're creating, does that mean you take care of it?
Right.
Or do I do it?
I would, well, in our case, we are creating a fund, so you can invest in the fund and you don't do anything more.
Any minimum amount?
Yeah, the minimum amount will probably be at 50k euros. But yeah, that's basically.
Okay.
But for us, you could do half, I guess.
Thank you.
It's not my decision. It's not my decision, unfortunately.
Okay. More questions?
Two small questions. Why only Bitcoins? And do you actually buy the Bitcoins or do you follow an index?
Good question.
Yes, very good question. Thanks. Well, we thought about including more cryptos, and I wouldn't completely exclude the possibilities that we still do that. But actually, we're more of the opinion that in this case, keep it simple is better. I mean, Bitcoin, as you know, is often referred to digital gold. So digital gold and physical gold is quite a nice combination. But also, I think Bitcoin is really the most secure, the cryptocurrency which is likely to survive the longest because it's so much computing power behind that, and because it has a track record of 10 years, which is quite long in this area, and didn't have any hack or anything. So it showed its robustness, whereas like other cryptocurrencies, for instance Ethereum Classic, which is still trading around, just recently had a 51% attack. So if that happens, basically you're gone. You wiped out, or the value of this token will drop really fast. And the probability that happens to Bitcoin is really, really low. So that's the store of value argument is basically responsible for us putting in only Bitcoin. And the other question was, sorry?
Physical Bitcoins you
yeah, so we can either even have it, it's called physical, yes, so cold storage, or do it via future, the Bitcoin exposure via futures, which is, I think, quite a smart option because it costs less and it still has very, very high security, because your exchange is the stock exchange, so the CME, for instance. So that's the cheaper way to do it.
Thanks for your reading. I expected a totally different story because I sold Bitcoin and gold, especially from a man from Austria, from Hayek. I read a book from Hayek of his paper, Denationalization of Money. So I expected that there would come a story about gold in the blockchain. Our new story, or something like Jim Ricketts says that the SDR in the blockchain and gold stored at the EMF. I expected this story, but you come with this one. Have you also a view on the two I mentioned?
Yes, we do. So actually both of them we touched during our last report, in Gold We Trust report 2018. First of all, we interviewed the nephew of Friedrich von Hayek, who also is a monetary theory, has a PhD in monetary theory, and asked him what he would have thought about Bitcoin and the upcoming of cryptocurrencies. And so he said Hayek probably would have liked the competition argument, but he thinks he wouldn't be a big Bitcoin fan. That was his opinion. But anyway, that what you said later on regarding blockchain, so tokenized gold, I would call it. We look at this a lot, and there's a lot of interesting products out there. Thing is, it again, you have a layer of trust again. So it makes this thing. It makes actually the initial idea of eliminating trust as much as possible a little bit difficult. So you really would have to be very convinced about the company who does a tokenized gold token, you know. So I think it's interesting. These things are coming up, but they are all developing, and to be able to gain such big trust that you really can invest in tokenized gold, you really need to completely trust these people at the end of the day. So I think this will take time, to be honest, but the technology could be enhancing a much broader use of gold. I believe that, yes.
Question over there. Are there more questions on this side? Last question?
Yes, two small questions. First, sir, how do you react on my comment that Bitcoin is created out of thin air? That's one. And secondly, I imagine that your system can be hacked. What will happen to my investment eventually? And is there a kind of an insurance?
Yeah, okay. Well, point one, yes, Bitcoin is actually only, if you want, a ledger, a database, but it is the first time where one can really transfer data from one point to another, basically. So that's the revolutionary part. So the internet has been here around for 30 years or something, but only since 10 years there has been some kind of a technology where we not only can send an email, which in reality is copied. We don't send anything, we just make copies of everything. But somebody found out how to uniquely have one data here and not there, and it's not being able to double spend. So it's true. I find this an interesting discussion. Does it have to be have to have some kind of commodity backing, or is there really the case for a digital asset? You know, I see both sides, honestly speaking. But as we are going more and more into a digitalized era, I think the case for some kind of digital assets are strong. And number two, yes, this is a very important point, securing digital assets in a fund vehicle, for instance. In that case, it's very important that if one invests into crypto funds, that they are regulated, in my view. Why is that? The regulation, European regulation, demands that you have a specialized custody bank, which is liable for safe custody. So it's not part of the bank, it's out of their balance sheet and so on, but they have to make sure that these assets are stored securely, and if they cannot, if they have a problem, they will have to pay, you know. So they have got insurance, and they have all kind of precautions that this doesn't happen.
Okay. Put it on. Can you hear me right now?
No.
Hello? Okay. That was good. We have one last question. We're a bit over time. We will have this question, and normally we should be back here at 4, but let's make that 4:15. So I think during the day we have been very, very good with timing.